Hi, everyone. Welcome to the podcast. Today I have with me Seth Turner. He's a managing partner at Synanthem Capital, a Dallas-based hedge fund that he founded and actively manages. Seth has invested and sponsored multifamily deals in the hundreds of doors and has been actively investing in commercial and residential real estate for over 20 years. Welcome to the podcast, Seth.
Thank you, Shamim. How are you? Glad to be here.
Yeah, great. I mean, why I wanted to interview you is you've got such a wealth of experience, and I was so fortunate to meet you through our extensive network, and I've learned so much from the short time that we've spent together. I thought it would just be really wonderful to share your knowledge with our community and take a deep dive into some of the specifics and changes that we've seen in the multifamily space.
Absolutely. Yeah. I've been investing for over 20 years in real estate, and I've invested in numerous other private offerings and where I've not yet lost any money. So that's, I think, quite an achievement. So happy to chat through that.
Yeah, that's amazing. So tell us a little bit about what is it that you look for in a property for a limited partner, which a lot of us are. What should we be looking for in the sponsor? Because I really like to emphasize the sponsor first and then the property, but tell us a little bit about what we should be looking for.
Yeah, I think certainly the sponsor has a huge impact on the outcome of all the different real estate deals out there. And through the years, I have learned that in many respects, the banks will underwrite the sponsor as well as the deal itself. And banks typically are pretty good at weeding out sponsors who don't have a significant amount of experience. And they typically go through the same brokers and the same sponsors, and sponsors can roll up the deals through the years to continue to get great deals.
So looking for that they've had a track record and a relationship with a lender is obviously very important.
Absolutely. I think also, there's the lending part and there's also the management expertise. You want to look for sponsors who have a track record of growing deals. Usually it starts out kind of with an 8-plex and then maybe a 20 and then 100 and then you get up to the multi-hundreds. And the other thing I look for is a sponsor who has experience not only in the Class C, there's the typical buy a Class C in a B part of town and then do a value add lift and then sell it as a B. But I look for sponsors who have experience in D, C, B, and A type properties.
And then what else are you looking for beyond that track record? And how do you get someone's track record, actually? Like the verification process of that, I think, is pretty challenging.
The verification process is very challenging. Usually I have a couple phone calls. Obviously, I review the private placement memorandum. Specifically, when I'm looking at a deal, I tend to be aware that a lot of deals only work if the exit cap rate and the exit interest rate are very favorable. Through the years, I've invested in a lot of properties that have promised preferred returns, let's say 8 or 10 or 12%. And most of the time, I didn't get any returns. I got no quarterly checks for years and years. But the exit price was so good because cap rates were declining, I was able to do very well from an ROI standpoint. So that's one thing to keep an eye out for.
Yeah, that's something that's changed dramatically, I know, in the last few years with multifamily specifically. Can you tell us a little bit more about how cap rates affected the returns and what happened in the multifamily space?
Sure, absolutely. Well, first, let's go back and review what a cap rate is. So let's say you had $100,000 to invest. And as any good steward of their capital would do, you would go look at the opportunities. So you might look at, let's say, a CD at your bank, and it might pay a 4% return. You might look at bonds, you might look at stocks. And my favorite, of course, is multifamily in the commercial real estate space. And a cap rate is basically a rate of return. If you bought a 4% CD, for instance, at your bank, and you put in $100,000, and at the end of the year, you got $4,000. That's a 4% return. That's what a cap rate is in real estate as well. So a real estate example is if, let's say, a property was producing $100,000 in income, and let's say you bought it for $1 million, you would get a 10% return. 100,000 divided by $1 million is 10%. And so the cap rate would be a 10. Now, another example, if a property was producing $100,000, the exact same amount, but let's say it was located in a prime location in a major city, that property might actually sell at $2 million. So for the same $100,000 in profit, you would have to pay $2 million for a premier property. And that's the interesting thing about cap rates, is it allows you to compare different properties. People will pay more per dollar of income depending on the type of property and the location and how difficult it is to manage and tax benefits. and things like that.
And so what happened with the cap rate? How do they change, first of all?
Real estate is unique in the sense that the deals are so large that everyone, nobody's putting in $10 million cash to buy a property. So if you're buying a $10 million property, usually you'll put 2 to 3 million in equity, and the rest you get a lender. And because real estate is leveraged, because the properties are so highly priced, interest rates end up having a hugely significant impact on the deal itself. So I mentioned that cap rate is the rate of return. So let's say you're at a cap rate of 6 and you go out and get a loan. The loan charges 4%. So you actually make the spread between the 4% of the loan that you're getting and the 6% cap rate. So what happens is if interest rates rise, if that 4%, let's say, goes to 6 or 7 or 8%, the cap rate has to rise as well, or there's no spread to be made and you can't buy the property. So that's been the significant factor that's happened over the last 3 or 4 years as the Fed has raised rates from 0 up to about 5.5 and now down to about 4.5-ish. It has had a significant impact on the cap rate of properties, which has a consequent impact on the ultimate price of the properties.
So what should multifamily investors be looking for? We've got to buy the properties at a better price, I'm guessing.
Yeah, absolutely price. So if you go back to the definition of a cap rate, it's the income a property produces divided by the price. You look at the denominator and the numerator, right? So if you look at the income, usually you want to look at a property where your income can go up. And there are ways to do that. You can reduce expenses at the property, but predominantly what people are looking for are markets where rents go up through time. And you can look for the number of jobs increasing. There are a variety of factors. You could look at states and cities, but in general, where people are moving to creates a supply and demand imbalance to where rents can rise through time. So you want to look at, can income go up in the numerator? And you want to look at, when you're buying a property, obviously you want the price in the denominator to be low. And of course, when you're selling, you want the price to be higher.
So what can a limited partner do to secure themselves in situations where, you've got the pro forma or the sponsor's projections, but you don't know how to predict the cap rate? What can we do to make a better assessment of if that investment is a good one?
If you think, let's say there's a great deal out there and you go show that deal to 50 brokers or sponsors and you say, hey, is this a good deal? How many of them are going to tell you no, right? They're all going to say yes, because they all want to get the commission on the deal. So the first thing is you can't listen directly to the person who's going to, can't ask a barber if you need a haircut. He's always going to say yes. So the most important thing that I look at is the exit cap rate and the interest rate, that the future interest rate that the sponsor is factoring in to their financial model. And apartments, they kind of have a certain lifespan of usually 5 to 7 years. Some of them, will stick around for 10, but they sort of flip. They change hands every 5 to 7 years. The way financial models work is, of course, it's kind of easy to model the next year. For instance, the complex has 90 to 95% vacancy. You know what the rents are now. The financial model will include how much expenses are going to rise, how much they think rents are going to rise. But the biggest factor is how much you're going to sell it for is determined by the interest rate that the buyer in the future is going to pay. And if interest rates go up in the future, it means a buyer is going to be forced to pay less because the debt service is going to be so high in the future. And that ultimately will determine the ROI of all of these deals when you exit at the end of the day. And so one of the things that I look out for, and first of all, I'll back up and say, the first thing I look for when analyzing a deal is I want to put it in the no bucket as fast as possible. I don't want to look for reasons why the deal makes sense. I want to weed out the bad ones. And in these days with higher rates, and you're familiar with the pretend and extend of the banks and how there's so much commercial real estate where the loans are coming due in the near term. That's something to look out for as well. But when you sell a multifamily complex, you have to leave some meat on the bone for the buyer. A buyer is not going to buy a complex where they can't make money, where they can't increase rents. So the idea that somehow you're going to get premier pricing in 7 years with an unknown interest rate, with an unknown cap rate, is kind of difficult. So for me, I I will weed out people who project an interest rate of, let's say, 3 or 4% and cap rates going down 2 to 3 points and things like that, because not even the Federal Reserve can predict where rates are going to be in 5 to 7 years.
So do you look at sensitivity testing essentially to determine if that's,
Absolutely. Yeah, that's
yeah.
a great point. So I do a sensitivity analysis. If a deal says that the cap rate will be 5 in 7 years or whenever the exit is, I will recompute the financials at a rate of 5, 6, 7, and even 8.
Mhm.
And then usually if the deal makes sense to me at those levels, then I can delve in deeper and see if it's something I want to take a look at. But one of the things I want to highlight, and maybe I'm a little more conservative than a lot of folks in the past, but since 2009, rates have steadily gone down. And remember, we talked about cap rates going down with rates at the same time. And when cap rates go down, the value of the property goes up. And so a lot of sponsors over the last decade, you could buy a property and rents could never go up and NOI could stay the same for 5 to 7 years, and you could make millions and millions of dollars essentially doing nothing. And they benefited kind of from that rising tide. And now we're in an inverse environment where if you buy a property and interest rates go up and you don't raise income, your equity investors can be wiped out. So I'm very cautious about that.
So it's a tough landscape right now with multifamily. I think it's the darling of commercial real estate. I think everybody loved multifamily for a while, and now it's really tough to find a good deal.
Yeah, I still am a bull on the asset class. I love multifamily. I made a lot of money with it. We have improved a lot of properties. I also believe that I've been involved in a lot of deals where the value add is a true value add for the tenants, and the properties are better and they're painted and they have new amenities and new playgrounds. And I think that's a really positive aspect of the multifamily space. I do think one of the things that's top of mind for me is the fact that every multifamily deal, most of them will have a 5-year term loan, 5 to 7 years. They have to refinance every 5 years, even though the amortization is stretched into 30 years of payments. Every 5 to 7 years, those loans have to be renewed and refinanced. And what's happening is if you purchased a property with an interest rate of say 5 and you refinance at an interest rate of 8, the debt service will explode. And as a result, a lot of properties that were purchased in the last few years, whenever they go to refinance, they're not going to make money and the bank might take the keys back, or they're going to have to sell at a loss. And that's why I think now is a wonderful time to build up your skills, build up your education in this industry, because over the next 1 to 2 years, we're going to see some amazing deals that we can get at attractive prices.
Okay, well, we're looking out for that.
Absolutely.
We're getting our community geared up for those opportunities. So very exciting. Well, I also want to pivot and ask you a little bit about hedge funds, since that's your other specialty. What is a hedge fund, and what kind of hedge fund do you have, and what are you doing with that?
Sure. Yeah. In its simplest form, a hedge fund is just a pool of money. In fact, it's a lot like a multifamily business where it's a limited partnership and there's a GP and you have a terrific deal and you share it with investors and they pool their money and you can go buy great multifamily assets. The thing that attracted me to the financial hedge fund, which is what I'm running now, and so we're doing equities and options in a portfolio. So it's the same thing. People can invest, in our fund. The thing that attracted me to it is, number one, I thought over the last couple of years, when rates were at zero, every multifamily deal I would look at was so insanely overpriced in my view that I didn't see there was a lot of meat on the bone for me. And I looked at everything. I looked at triple nets. I wanted to get some Walgreens leases and shopping malls and multifamily and anything. But the prices were so high because the interest rates were so low. A lot of your returns are based on the price you pay. After 20 years of successful real estate investing, I was forced to kind of look outside the box. So I formed a financial hedge fund. So far, the thing I love about it is the liquidity, right? One of the great things about multifamily assets is they're low risk. They're some of the lowest risk types of investment deals you can put your money into, which is fantastic. But you're illiquid for 5 to 7 years until the deal sells. And I've also learned, as I mentioned in the past, that a lot of the quarterly preferred returns, typically they didn't materialize for me in my experience. Maybe a big CapEx project came up. Maybe there needed a new roof on the property. Maybe something would happen. And so while I did well, and I made in some cases 20, 30+% returns on some terrific multifamily deals, I did have to wait 5 to 7 years. Until multifamily prices come down and interest rates and cap rates stabilize, I have a pool of investors who are actively investing in my fund, and we're investing in equities, and we can hedge the market in the downside and the upside. And I'm having a lot of fun with that as well. But
Yeah.
I will always be a multifamily investor when the price is right and things stabilize a little bit.
Yeah, well, very good. So we talked about the sponsor and how to evaluate them, and then you've talked about the cap rates. Is there anything else you'd like to tell us about the deals that we see? I know we talked a little bit about the market. I think that's another focus. First of all, looking where the market's growing and the sponsor's track record. What else do you think we should be looking out for when we see these deals?
For me, circling back on this idea of having a no pile and moving deals into the no pile pretty quickly. And the number one thing I would look out for, and I know I'm being a little repetitive, is just to look out for a deal that emphasizes the exit with a cap rate going down and interest rates going down. I think the returns are a little dubious, and I think a little more hopeful than realistic. So generally, I'll say a quick no to those deals, but the ones that are a little more realistic maybe have a sensitivity analysis. The other thing is, again, looking at where people are moving to. Generally one white collar job equates to about 5 blue collar jobs. New jobs in any market is just the best place to invest in real estate.
What's your resource to follow the trends in the market?
I read everything. I'm a voracious reader. Through the years, I've relied on something called the Milken Report, which is a nonprofit institute, and it ranks cities based on job growth and tech and other factors. I also look at kind of a rule of thumb. I use the U-Haul one-way move report that they publish every year, and I get to look and see where people are renting U-Hauls and where they're moving to. And over the last 5 to 10 years, it's generally been from the north to the south. It's generally been to the Sun Belt states, and those have been terrific places to invest during that time.
Okay, well, very good. Well, thank you so much for your insights. This was really useful, and I'm excited to learn more about your hedge fund in the future.
Terrific. Yeah, I'd love to talk about that, but I'm always keeping my eye on multifamily, because I'm telling you, in the next couple of years, there are going to be some amazing properties to buy, and there'll be some terrific alternative investments.
Okay, perfect. Well, thank you so much.
Thank you so much, Shameen.